Hi, everybody. Welcome to Accounting 4910, Advanced Accounting. I'm Dr. Elaine Gregory, and I'll be your instructor for this term. I'm going to be providing you weekly summaries of the highlights of the readings that you will be doing in your textbook. Now, I don't want you to substitute reading because there's going to be tons and tons of examples that will lead you through some of the areas in the class that we'll be teaching. So take this and use this to augment your textbook. So in our first week, we're going to talk about the Securities and Exchange Commission and the equity method of accounting. So let's jump right into it. Our first reading is Chapter 12, Financial Reporting and the SEC. Now, the SEC dates way back to the 1930s during the Great Depression, when we had the very large stock market crash. And that's when people went from millionaires to nothing. And so the Congress created the US SEC as a result of that depression. And it requires the registration and regulation of all securities that are traded and sold in the United States. In addition, the SEC was formed to separate investment banking from commercial banking. So we had two separate sets of banking, and we had protections set up on those commercial banking deposits. Now, everything was going along pretty well from 1934 to the early 2000s. Then the corporate financial scandals of 2000 and 2001 hit. And those were some of the scandals, such as the Enron off-balance sheet financing scandals, WorldCom, Tyco, etc. And as a result of those corporate financial scandals, Congress set up what's called the Sarbanes-Oxley Act. And that was to ensure sound internal controls, management's ownership of the financial results, and made some requirements as far as auditors. For example, auditor turnover. You had to cycle out your auditors after a few years. In addition, the SEC created the PCAOB, the Public Company Accounting Oversight Board. We also call that the peekaboo. And it was created to monitor and regulate auditors of these public companies. Now, I put Arthur Andersen in parentheses because during the Enron financial scandal, the Houston office of Arthur Andersen, their main revenue source came from Enron. And so what occurred was Arthur Andersen became too close to Enron, and they lacked their independence. And they allowed Enron to do what we call today creative accounting. Now, you don't see Arthur Andersen anymore because shortly after the Enron scandal, Arthur Andersen folded because they were found in violation of things such as allowing non-standard changes to how the company conducted their financial business. They were actually caught shredding documents to protect themselves and to protect Enron. So the company is no more. So that happened back in the 2002s. What it caused after 2002 was more intense scrutiny over how auditors audited the internal controls of the company. A lot of people complained about this because it ended up costing companies much more to have an audit performed than it did in the past. Today, the SEC performs 5 main functions. They oversee publicly traded companies. They provide safeguards for fair and efficient trade markets. They protect investors. They investigate security law violations. And they monitor the changes in the economy and the associated risks. And what they usually will put out is a risk assessment that points out certain issues that are coming within the economy that could have adverse effects on publicly traded companies. Now, for a company to trade securities, they have to go through multiple steps. This focuses just on either debt or equity securities, such as companies that issue corporate bonds or companies that issue common and preferred stock. So there's a number of filings that are required prior to selling securities or bonds. They have to provide a lot of non-financial information about their company, the mission, vision, goals of the company, as well as they have to follow a specific form and content of the financial statements that are required to be submitted for approval that are read by potential purchasers of these bonds and stock. Now, while it's rare, the SEC does have the power to overrule the FASB, the Financial Accounting Standards Board, on some methods of accounting. And there was a really good example in your text to read on that. So before they can issue those corporate bonds or stock, they have to provide information of the securities to the public. It has to be transparent. It has to talk about the budgets that they are planning on doing, what they plan on selling the stock for, and what they plan on doing with new bonds or new common or preferred stock. Then once the securities are active, they're being issued and traded, companies have to file periodic filings. The SEC 8K, the 10K, and the 10Q. Let's take a look at these a little bit deeper. The 8K is to provide information to shareholders and to the public on any significant material events that may have occurred. Now, some of these could be changes in the percentage of ownership of securities. People have bought or sold 5% usually or more of their shares. It could be announcements such as potential acquisitions of other companies, potential bankruptcy, changes in the board of directors. Perhaps they've changed their fiscal year from maybe March 1 to December 1. They're filed as needed and when needed. And these, plus the 10Qs and the 10Ks, are all available for review on the SEC EDGAR database. Now, if you go into a company, you may see monthly information, monthly 8K filings that talk about all kinds of different things. So I wanted to bring up the February 2023 Amazon 8K. And what this is basically saying is it's announcing its fourth quarter and year-end financial results. They have a copy of the press release and additional information on non-GAAP financial measures, public disclosures. So basically what they're saying is, here we are, we finished our fiscal year in December 31, 2022, and in February 2, we are announcing, because it does take time to close your books, we're announcing our fourth quarter and preliminary financial results. These are not audited financial results yet. Now, the 10Q is a quarterly report, and it's pretty comprehensive, and it's required for all publicly traded companies. So every quarter, you have to do your quarterly report of financial results, and it's generally unaudited. It's rarely audited unless there is something that's going to go on, perhaps in the third quarter, that may be significant, where the company self decided on their own to go ahead and get that audited. Again, here is the Amazon as of September 30th, 2022. So that was the end of the quarter for Amazon. And so they filed their 10Q. And I wanted to point out, this is the language that's in the 10Q, but I bolded a section of it saying the operating results for the periods are not necessarily indicative of the results that may be expected due to seasonal and other factors. So they closed their quarter, but they're saying, hey, this is only as of perhaps the third quarter. We don't know what's going to happen by the end of 2022, because there's a whole nother quarter yet that could have some activity. So there could be seasonal factors. Also, these are not audited. So they're kind of warning you that the information's out there, but it's not audited. It cannot be fully relied upon, as this is the actual results of the company. Now, finally, Amazon will file for the fiscal year ending December 31st, 2022, their 10K. It's the annual report. It's audited. It's required by the SEC. And there is certain specific information that must be in the 10K. We have to talk about the company, what it does, maybe what any changes that happened in the company. We talk about risk factors, both internally within the company and externally, that may be out of their control, such as the pandemic, such as economic changes that have occurred. They will then select 5 years of financial data so that the reader can see the performance trends. Management's discussion and analysis about how they feel performance has gone, where they see themselves moving on, where they see information that they may need to disclose. And finally, we have the financial statements and other data. And other data could be are the notes that break out the information contained in the financial statements, and other data such as perhaps some supplemental data. Now, I wanted to pull the audit opinion from Ernst & Young on Amazon, and I wanted to point out just some specifics. This is basically boilerplate language, unless there is something that has to be called out. So the opinion on the internal control over the financial reporting, we see that here's the opinion. In our opinion, Amazon.com Incorporated, the company, maintained in all material respects effective internal controls over the financial reporting as of 12/31/22 based on the COSO criteria. So they put a lot of information in that one sentence. First, in the opinion of the auditors, in all material respects, there was effective internal control over the financial reporting based on the use of the COSO standards. Now, in the second part, the basis for the opinion, what did they do? We conducted our audit in accordance to the standards of the PCAOB, and it requires that we plan and perform the audit to obtain reasonable assurance, not 100%, but reasonable assurance. And then we talk about what our audit included, what we did, and that we believe our audit provides reasonable basis for our opinion. Now, that's not just to hedge against, to protect the company. You don't do 100% audits. So you can only test. And as you test, you create materiality levels for the basis of the audits, and then you form an opinion of them. Now, there are some exceptions to SEC requirements. Government securities are not required to be under the guise of SEC requirements. Government securities are not, while they are publicly traded, they are sold by an entity or by the municipality or government. There's no reporting that needs to be done with the SEC. Bank securities, the same thing. Now, there may be some small dollar securities of publicly traded companies, but if they're very small in nature, they don't have to have the full reporting, but they may have to require some disclosure in the SEC. And another exception to the SEC is securities sold within the state that the business operates in. They don't operate anywhere else. They operate in Oklahoma. They're a public company. They trade securities, but they only sell them within the state of Oklahoma, and they only conduct business within the state of Oklahoma. They are exempt from SEC filing requirements. However, they may be subject to state filing requirements. So if you've got one of those small state securities, you may need to look to see what the state requirements are in filings for those publicly traded securities. Now I'm going to go through a really quick demonstration on accessing EDGAR. You go into the sec.gov, you type EDGAR in the search, it will come up with the EDGAR website. Click on it. You would type in the name of the company in the company person lookup. And here I had typed in PepsiCo. And it comes up. It's really neat now. It used to just be this laundry list of forms that you had to go through and try to find your form. Now it lumps them all together. So if you want to look at the 8Ks, you would click on that and it would bring up all of the 8Ks together. The 10K, proxy statements and informations. It could also include pro forma financial statements and ownership disclosures. Really cool. And then it tells you what the latest filings are. So here we had an 8K in October. We had a 10Q in October. Oh, looks like we had a certificate filing. And then we had a registration of securities. So those are all the latest things that happened in PepsiCo at the end of 2022. But this is the really cool part now, is the selected filings. You click on it and it brings up all of the 10Qs and 10K annual reports. Here's your 10Qs. There we go. Your annual report for December 2021 right there. So if you want to look at it, you just click on it. It brings it up in a PDF and you can read to your heart's content. So that's enough about the SEC. Now let's talk a little bit about the equity method of accounting for investments. The first thing we have to do is look at what the classification of investments are. And there's really 3 classifications. Passive investors, investors of significant influence, and controlling stock. And we're going to focus in on the significant influence at this point. So significant influence means any ownership of 20% but less than 50%, so 49.999, they fall under the equity method of accounting. There's other requirements for passive investments and controlling investments. Now, the fun part about this, and this is the super fun part, is you could have significant influence, but own less than 20% of their stock under certain conditions. So you may own 18% of the stock, which would make you a passive investor, but you might have, as the parent company where you are investing in the subsidiary, you may have parent people sitting on the boards of directors. That can create influence because they have voting rights. A parent could have key managers in the subsidiary's company. They might be swapping people back and forth. That could have significant influence as to the direction of the company. They could direct, control, or develop policies of the subsidiary company, which would then create significant influence. And another way they could do it is just by contractual agreement. You have 18% of ownership of the company, but the subsidiary company is going to allow you to be a significant influence by agreement. Companies have to put in their notes to their financial statement how they are measuring and recording and reporting their investments. And so I pulled Amazon's 2022, and they come right out. Equity investments are accounted for using the equity method of accounting or at fair value if we elect the fair value option. So they have to state that right out there. This is on page 48 of the 2022 financial statement. And it tells them exactly how they are going to account for them, how they report their earnings or losses, how they amortize, how they report it net of tax, and whether if the investment declines in fair value, they can write down the investment to its estimated fair value if fair value falls below carrying value. So all this information is very important. It tells you exactly how they are measuring, reporting, and accounting for their investments. Now, here's some rules that go on with the equity method of investments. The investor, the parent, will report a portion of the income, net income, from the subsidiary's financial statement in their financial statement. They are also going to record any profit or loss of the company, the subsidiary company, in their other comprehensive income, loss, or discontinued operations. Now, when a parent company receives a dividend from the subsidiary company, it actually decreases the owner's equity within the parent company. So whenever they get dividends, the owner's equity is decreased through a debit, and the investment count is decreased by the credit because the dividends reduce it. And it says to record dividends from the subsidiary company. Some more rules. Most of the time, the price the parent pays to the subsidiary company for their investment exceeds the book value of the stock. Therefore, most purchases of investments will give rise to goodwill. So that excess payment has to be associated with the investment, or it's allocated to the intangible asset of goodwill. And then goodwill is amortized over its expected life, and that will affect the equity income recognized by the investor because we have to factor in the amortization of that goodwill. Now, if the investor, the parent, decides to sell part or all of their investment, we apply the equity method until the date of disposal. So they may call out in the board of directors that at the end of the fiscal year, they intend on selling their shares of a subsidiary stock. We wait until the date of disposal to apply the equity method. So we want to go all the way up to that date, and then we recognize the gain or loss based on the adjusted book value at the date of disposal. Now, if they only sell part of it and there are any remaining shares, they can be accounted for by equity or fair value, depending on the degree of influence in the remaining shares. So if you sold enough to go down to maybe only 5% ownership, you would then record it based on the passive ownership rules. Now, we know that at times there can be more than just the investment of stock that creates a relationship between the parent and the subsidiary. There could be other instances such as intra-entity transfers, and we'll get into that later on, where the parent may sell or loan assets to the subsidiary may do the same to the parent. And so equity income is adjusted based on that gross profit of the inter-entity sales. And they stay there until those items are further sold or consumed internally. For example, a company that makes computers may have an investment with a subsidiary company who produces the microchips. So then the subsidiary sells the microchips to the parent, and then the parent adjusts the basis of gross profit for that intra-entity sale once those computers are further sold. Or we could have a company that buys coal from a subsidiary that invests in a coal company, and they're using the coal to manufacture their own products. When the subsidiary sells that coal to the parent company, we record the gross profit of that sale after the coal is then consumed. So again, that amount of the intra-entity gross profit in the ending inventory reduces the equity income that's recognized by the parent. Finally, a company may elect to report significant influence investments at fair value, but any changes in fair value will affect their earnings. So when a company elects fair value, they report the investment's fair value as an asset, and then the changes in the fair value as the earnings. So it becomes an asset to the parent company. That's all I have for this week. So again, this augments your reading. It doesn't substitute for your reading. So take care, and I'll see you in the classroom.